I am Srinivasa, doing PGDM in Finance at International School of Management Excellence. Today, I am going to explain how property trading works. Through three segments it works. First of all, derivative segment, and then REIT. REIT means Real Estate Investment Trust, and then third one is equity segment. Now, we will discuss about derivative segment. In derivative segment, there are many strategies. Now, I am going to explain strangle strategy by using an hydraulic crane. Why we are taking strangle strategy? Because of IB is investing their own money, so they can take however risk they want. Here in strangle strategy, there will be a two strike prices. One strike price is at 170 rupees, and then second strike prices are at 180 rupees and then 160 rupees. If market goes up, call get activated, and then when it reaches to 190 rupees, the gross profit will be 10 rupees and the net profit will be 0 rupees. Why? Because we are paying premium of 10 rupees. When market goes further up, when it reaches to 210 rupees, the gross profit will be 30 rupees and the net profit will be 20 rupees. Why? Because we are paying premium of 10 rupees. When market goes down, when it reaches to 150 rupees, the gross profit will be 10 rupees and the net profit will be 0 rupees. And then when market goes further down, when it reaches to 130 rupees, the gross profit will be 30 rupees and the net profit will be 20 rupees. Here, the break-even points are at 190 and 160 rupees. When market goes up, call option will be activated. When market goes down, put option will be activated. Here, break-even points are at 180 rupees and 150 rupees. Here, during call option, a profit starts from 190 rupees. During put option, profit starts from 149 rupees. This is how derivative segment works. When market goes up also we can make profit, and when market goes down also we can make a profit. I am going to explain REIT through a hydraulic lift in a building which has two blocks. First block represents projected investment and second block represents demand. Here we can see this building consists of three floors: ground floor, medium, first floor and then top floor. Ground floor represents low level of projected investment, and then first floor represents medium level of projected investment, and then top floor represents high level of projected investment. Same in demand building also, we have three floors, which low level and medium level and then high level of demand. Here we are using three triggers. First trigger is taxation, and then second trigger is SEBI regulation, and then third trigger is interest rate. Previously there was a tax of 30%. That means whatever you get return from the REIT, you have to pay 30% from the return. Now there is no tax. When it comes to 0% tax, here we can see Nifty is moving up. That means projected investment is increasing as well as demand is also increasing. Previously, and then if we come to second trigger, previously there was no regulation from SEBI. Now there is a regulation from SEBI. That means investor got trust on this REIT, so people have started investing in this REIT. So when now SEBI is regulating, so people started investing more investment, and then demand also increasing. Now the third trigger is interest rate. Here I have taken example. Interest rates are like 8%, 10% and 12% and 14%. When interest rate is at 8%, the investment is at medium level and then demand is also medium level. When interest rate goes up, that means from 8% to 14%, when it goes up, here we can see Nifty is further moving up. That means project investment is moving up and then demand also moving up. This is how REIT works. 7 years is the locking period in this REIT, and Return of REIT in India so far is 5 times to 12 times. Let us discuss about equity segment. Here I am going to explain equity segment through a normal filter which consists of charcoal and then sand. Here, first of all, we should select the inverse. Here I am taking inverse as a unfiltered water, and then we should do predictive modeling on those inverse. That means here this charcoal acts like a predictive modeling technique. Then we should do gauge techniques. Here sand works like a gauge technique. The efficient stocks will be like a filtered water. Now when we pour this unfiltered water, the charcoal acts as a predictive modeling and then sand acts like a gauge technique. Here you can see pure water is coming. So this is how it works. That means instead of investing in whole inverse, after doing predictive and gauge, you can invest in efficient stocks where you can get return. Let's come to the calculation part. Here I have taken inverse Nifty small cap. Then I clean the data and then I have done predictive modeling on those stocks. After predictive modeling, I have removed the stocks which will be giving the very low returns. Here you can see in red mark which will be giving very low returns. Then I have done gauge technique to these stocks individually. After doing gauge technique on all stocks, this gauge model shows log likelihood of each stocks. So these are the levels of volatility of each and every stocks. Based on the investor risk, he can go to the high level volatility of stock. This is our low level of volatility. This is how equity segment works.